Hello, this is Tim Dial with Next Mortgage, and I just wanted to put this together. This is going to be pretty short, but I wanted to put this live stream together just to let people know about a new program that's available. It's called the All-in-One Loan. I just went through some training, got certified on it. I'm very excited about it. As a matter of fact, I'm so excited about it that I am planning on within the next month refinancing my own house into the all-in-one loan because it's just an incredible program. And I'm going to go into real quickly why it is so valuable and who it's for. In my opinion, the best people that this is going to be a fit for will be people that either have a decent amount of equity in their current home and they're planning on selling their home and purchasing something else and they can utilize that equity, or there's somebody who currently owns a home and they're looking to refinance and go into this product, and it'll save them a lot of money. So the big difference between this and a fully amortized 30-year mortgage is the way interest is calculated. So I don't know if a lot of people don't realize just exactly what a 30-year amortized mortgage is and why it's so costly. So I wanted to go into that real quickly first to give you a little bit of background. Banks figured out like 80 years ago that a 30-year amortized mortgage would make them lots and lots of money. And this is why. And it's because of the way the amortization schedule works. You're paying almost all interest on the front end. So a lot of people think, well, I got a 6% interest rate. That's not a bad interest rate. 6% is pretty low compared to like an 18 or 20% credit card, right? So it sounds low in that regard. There's some people are even like 3 or 4%. Oh, it's a really great interest rate. But what they don't realize is that you're paying all of the interest on the front end during the first few years, right? So I did some calculations here just as an example. If you were to buy, let's say you bought a $400,000 house, or you had a house that's worth $400,000, and let's say you did a loan for $320,000 on that home, then during the first 8 years, you'd pay interest of about $145,000 during the first 8 years, and that's at just say a 6% interest rate, which is about where interest rates are right now. So you pay $145,000 on a 30-year loan, and that's during the first 8 years. And you'd pay about $39,000 worth of principal during that same 8 years. So in reality, during the first 8 years, you're really paying over 300% interest on it during the first 8 years. And it actually takes you, if you make your regular payments on it, it would actually take you about 21 years to pay 50% of the balance down. And that's the way they have it set up, because the interest is so front loaded that you're not going to pay half of it off in 15 years. You're going to pay half of it off in 21 years. So, and then toward the end, you start paying almost all principal, but most people don't stay in their house for 30 years, right? So what happens is somebody will buy a house, they'll live in it for 5 to 10 years. And then at the end, or sometime during that 5 to 10 years, they'll decide they're going to sell the house and buy something else. So they do a 30-year loan, stay in it for 5 to 10 years, and then they will sell the house, buy something else on another 30-year loan, and stay in it for a period of time. So they're paying all that front-loaded interest on one house, then they buy something else, and they're paying all the front-loaded interest again, right? That's just the way it works. So it's still not a terrible idea because the value is increasing on these homes, and you're still gaining equity, right? But a lot of people don't realize just how much interest you're paying. 6% interest rate, thinks, it's not that much interest, but in reality, you're paying over 300% interest the first 8 years. So what makes the all-in-one loan different is that they calculate interest on a daily basis instead of amortized over 30 years. And it's based on what your balance is at that time. So what they do is they have you set it up. It's not just a mortgage. It's like a home equity line of credit. And so the way it works is it's your mortgage, but it's also an account that has extra money available on it. And they set it up so that your deposits, when you get a direct deposit, your deposit goes into the account and it pays the mortgage down. So you're using your money instead of it just sitting in a bank. So it pays the mortgage down. At the end of the day, they calculate interest based on what your balance is at that time. It's daily interest. And then toward the end of the month or whenever your bills come due, then you pay those bills out of the same account. And then the balance goes back up. Your deposits come in, it pays it back down. You make your payments and the balance goes back up. So you're actually utilizing your pay every time you get paid. Your pay goes into the account, pays the balance down, so you're paying interest on less money. And that's kind of the key. And we're seeing people who are doing this. There's actually a tool that we can use to figure out, kind of what your time frame would look like with being able to pay your mortgage off a lot faster. But a lot of people are able to pay the mortgage off in 10, 11, 12 years using this program because of all that interest they're saving, because the way they do the calculations. So, and it's also gives you some peace of mind as well. If you get into a tough time, where you have some expenses come up or something, you have that, it's, because you have that extra equity available on the account. If you had something come up, let's say your air conditioning went out, you can just put the air conditioning on the account and pay it up. Pay it off with the account, and then you start paying it down using your deposits just like normal, but you're not stressing over, oh gosh, how am I going to afford to replace my air conditioning? So it really does. And the other thing it does too is it helps people kind of manage their finances better, because you get to see every month, is my balance going down the way I want it to? And it really puts that in the back of your head. If it's not, you can look at your finances and go, oh gosh, I spent $500 on eating out this month. That's terrible. I have to lower that. So it makes people more aware of their spending habits and what they're doing in order to save more money. And so it's just a great idea and a wonderful product and program. But I'm going to have more videos. I'm actually going to include lender videos. The lender that does this, like I'm with Nexa Mortgage, and we are a broker. We have over 200 lenders available. The lender who has this program is called CMG, and we are a wholesale lender for CMG, or they're a wholesale lender for us, I should say. And so CMG also has a retail division, but our interest rates and things are actually better than their retail offices can offer because they give us wholesale pricing. So anyway, I'm going to include some videos that they put together, which do a great job. I thought about recreating them myself, but I'm like, these videos are so good. I got their permission to actually load those videos on my YouTube channel. And so I'm going to be uploading those videos as well. And they do a great job of explaining exactly how the program works and things like that. And I may do another video like this later and go through the whole amortization chart and stuff so that people get to see that end of it. But I wanted to do this first as just kind of an introduction. And then I want to upload the CMG videos as well so that people get a better feel for for the program, how the program works, and why it's so good and why it's going to save them a lot of money. So anyway, that's pretty much it. Look forward to talking to you. If you have any questions or anything, my number is 615-995-2615, and look forward to talking to you soon. Thanks.